Today I will explain you stock investment strategies. Understand each point carefully, it will definitely help you in investment strategies. Let's start. 1. Value investing. This strategy involves identifying stocks that are undervalued compared to their intrinsic value. Investors believe the market will eventually recognize the stock's true worth. Example: suppose a stock's current price is $50, but based on analysis of its earnings, cash flow, and assets, the fair value is estimated to be $70. A value investor would buy this stock, expecting it to rise to its intrinsic value over time. 2. Growth investing. This focuses on companies that are expected to grow their revenues or profits faster than the market average. These companies often reinvest earnings into expansion rather than paying dividends. Example: an investor notices a company in the tech sector with a new innovative product. Its revenue is growing 30% annually, and it operates in a rapidly expanding market. The investor buys shares, expecting long-term growth. 3. Dividend investing. This strategy targets companies that pay consistent and high dividends, offering a steady income stream in addition to potential stock price appreciation. Example: an investor buys shares of a stable company in an industry like utilities, which pays quarterly dividends. Even during market downturns, the investor earns a reliable income from these dividends. 4. Index investing. A passive investment strategy where investors buy funds that replicate the performance of a market index. Example: an investor wants exposure to the entire stock market without analyzing individual stocks. They buy shares of an index fund that tracks the performance of a major stock market index, offering diversification and reduced risk. 5. Momentum investing. This involves buying stocks that have shown upward price momentum and selling those with downward trends, assuming trends will continue. Example: a stock has been consistently rising for several weeks due to strong earnings and market optimism. A momentum investor buys shares, betting that the price will continue to climb in the short term. 6. Contrarian investing. Contrarian investors go against prevailing market sentiment, buying when others are selling and vice versa. Example: during a market crash, a stock in a strong industry sees its price drop significantly due to overall market pessimism. A contrarian investor buys shares at the low price, expecting a recovery once the panic subsides. 7. Sector-based investing. Investors focus on specific sectors or industries they believe will outperform the broader market. Example: an investor predicts that renewable energy will grow significantly due to government policies and consumer demand. They allocate most of their portfolio to stocks in the renewable energy sector. 8. Buy and hold strategy. A long-term strategy where investors purchase quality stocks and hold them for years or decades, ignoring short-term fluctuations. Example: an investor identifies a company with a strong competitive advantage, solid financials, and steady growth. They buy shares and hold them for 20 years, allowing the investment to compound. 9. Speculative investing. This high-risk strategy involves investing in stocks with significant potential for high returns, but also a high probability of failure. Example: an investor buys shares in a small, unproven company developing a new technology. If the technology succeeds, the stock price could skyrocket. If it fails, the investment could be lost. 10. Technical analysis. This strategy involves studying price charts and using technical indicators to predict future stock movements. Example: an investor notices a breakout pattern on a stock's price chart where the stock has surpassed a resistance level. They buy shares, expecting further upward movement. 11. Fundamental analysis. Investors evaluate a company's financial health, industry position, and growth prospects to determine its intrinsic value. Example: an investor studies a company's balance sheet, income statement, and industry trends. Based on these, they conclude the stock is undervalued and buy shares. 12. Risk management. A strategy to minimize losses by diversifying, setting stop-loss orders, or balancing high-risk and low-risk investments. Example: An investor allocates 60% of their portfolio to stable, large-cap stocks, 30% to bonds, and 10% to high-growth but riskier small-cap stocks. This diversification reduces overall risk while allowing for some potential high returns. These strategies can be tailored to an individual's financial goals, risk tolerance, and market outlook. Combining multiple strategies is also common for creating a balanced investment approach. Thanks for watching.